Hi and welcome to Swissquote's Daily Market Talk. It's Monday, June 23rd. The US bombed the Iranian nuclear facilities over the weekend. Oil jumped open the week, but the early gains have been given back. The safe haven assets show no signs of an excessive worry or a worry at all, and equity futures are only slightly down this morning. But the market moves reflect in no way the gravity of what we see in the headlines regarding the geopolitics of the Middle East and the potential risk of escalation. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week kicked off with a jump in oil prices as the US finally got involved in the Middle East tensions, bombing the Iranian nuclear facilities over the weekend with what they call bunker busters. They actually tried to destroy the underground nuclear sites of Iran with these powerful bombs that only they have in their possession, if I understand well. Now, it's yet quite unclear for everyone how much damage the US has done to these facilities, but Donald Trump says that they've done monumental damage. Now, the world is holding its breath to see how Iran will respond to this weekend's attacks. The country said that all options are open. All options include trade disruptions through the Strait of Hormuz, obviously, where 20% of the global oil and gas flows transit from, by blocking the canal or by attacking the commercial ships that sail through the Strait of Hormuz, like Houthis do, for example, in other parts of the Gulf. The options also include striking nearby oil facilities, like the 2019 attack on Saudi Abqaiq that knocked out 7% of global oil supply, but that was quickly restored. So many actually remain quite optimistic that Iran will avoid a full blast retaliation and a further chaos in the region to avoid getting its oil facilities under attack and from widening conflict that could eventually hurt China, which is the biggest buyer of the Iranian oil. And so something and trade the idea that the threat of disruption to oil and gas trade will not materialize or it's not going to last long enough. So in this context, US crude actually opened the week at $78 per barrel level, but didn't make it much higher than $78.60 per barrel before starting to slide toward the $76 per barrel mark. Brent didn't even reach the $78 per barrel level this morning, while natural gas is up by less than 1% at the time I am talking here this morning. So far, the satellite images reportedly suggest that oil continues to flow through the Strait of Hormuz, which may explain the muted market reaction to the weekend news. But two super tankers, each capable of carrying 2 million barrels of oil, made a U-turn to avoid the region, according to Bloomberg News. The Persian Gulf is increasingly jammed since the June 13th tensions started. The tanker fears are soaring these days, and the US also issued a warning to broader region, hinting that more could be to come. So things get uglier and Iran retaliates in a way to disrupt global oil and gas flows. The barrel of US crude could still spike above the $100 per barrel level. That is a possibility. Right now, though, top selling the jumps in oil prices on geopolitical headlines looks like the major play, but holding a short position beyond a few hours or a few days is probably too risky right now. Setting stop loss and take profit levels could actually help you limit risk and manage the uncertainty in this increasingly uncertain geopolitical setup. If you are trading oil, it's worth remembering that it would take only a few days and maybe just a few weeks to disrupt the global oil flows and weaken Iran if left with no other option could possibly go there and disrupt whatever is transiting from the Strait of Hormuz. A sustainable jump in oil prices on the other hand, and by sustainable I mean not more than a few months, but if we see oil prices rise around $100 per barrel level for a few weeks or longer, well, we could see wider implications for the global economy because it would boost inflation and prevent the central banks from further easing their monetary policies and lowering their rates, and the latter would weigh on production, on business activity, and weigh on growth. Therefore, global equities will likely remain under pressure at the open, but looking at how oil prices reacted to the weekend news, I actually believe that the sell-off that we might see in equity prices will remain relatively soft compared with the heaviness of the headlines. We could even see gains by the end of the session. I mean, the S&P futures are down by only around 0.30% at the time I'm talking here. This morning, they're behaving just like a normal Monday morning. And that is something that I actually find extremely interesting and fascinating. It really feels like the markets have become increasingly unreactive to the bad news. All they do is to trend higher. It is maybe me, but the lack of reaction or the lack of proportional reaction to the news is very interesting and quite fascinating still. Now, beyond oil, the US dollar jumped at the open this morning, but gains remain relatively small there as well. The US 10-year yield is softening, but not by much, and gold has given back earlier gains, while the Swiss franc is not necessarily higher this morning. On the contrary, traders are benefiting from below 115 levels to flock back into the euro. Cable is bid into its 50-day moving average, but the Asian majors are a little bit more under pressure than the European peers. The dollar yen, for example, jumped past its 100-day moving average this morning and is trending higher despite a softening US dollar across the board following the initial jump that we have seen, while the Aussie dollar, which has a decent China exposure, which does have exposure to Iranian oil, slipped below its 200-day moving average this morning and remains under pressure despite the rest of the market not showing a particular sign of stress to the Middle East tensions. Now, the geopolitical tensions will obviously remain on top of the weekly headlines, but for those who are still interested in something else than the geopolitics, there will be a set of PMI data due to be released today across Europe and Americas, while the Fed Chair Jerome Powell will be delivering his semi-annual testimony this week on Tuesday and Wednesday before the US Congress, and he will probably not say more than, "We don't know what will happen," in the middle of the high and rising trade and geopolitical uncertainty. So the best approach for the Fed is to wait and see, he will probably say. Then we will watch the fresh US GDP update later this week, which is expected to point at a solid decline in the first quarter sales with sustained price pressures in the US. Then by the end of this week, Japan and some major Eurozone economies will be releasing their own latest inflation updates. Here, the relevance of the inflation numbers from Japan and the Eurozone countries will obviously depend on the size of oil price movements. For now, they don't look threatening, but oil prices still jump more than 20% compared with the pre-Iranian tensions, so that will be a place to keep an eye on and could already be visible in inflation numbers for June. Now, before we go, let's finish this episode with lighter news, if you will. Tesla finally launched its robotaxis in Austin, and the first feedback from the experience is that the rise went smoothly. So we are talking about a handful of these robotaxis in Austin streets on a limited map, and will not replace the loss of revenue from the melting car sales at Tesla. But this is one of the biggest bets. So the robotaxis are one of the biggest bets of the company, along with AI and humanoid robots, and has a potential to reverse the fortunes of the share price, at least if Elon Musk could keep himself out of trouble or simply out of the headlines. So Tesla's share price actually recovered more than a third of the latest Elon Musk related Elon Musk-led sell-off since the December peak, which was also a Elon Musk-led rally, mind you, and the price is now sitting on a major Fibonacci level on the latest sell-off, consolidating gains just at the bottom of the medium-term bullish consolidation zone. So this could eventually be the start of a fresh positive push for the Tesla's share price if it is backed by soft yields and optimism regarding the robotaxis. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.